Click buy on a commission-free trading app, and the order will most likely never reach a stock exchange at all. It stops one step earlier, at a private trading firm that paid for the right to see it first. The screen gives almost nothing away. A green confirmation, a fill price carried out to 4 decimal places. Between the tap and that confirmation sits a window of a few hundred milliseconds, and inside that window, the order has been received, inspected, priced against a live picture of the market, filled and reported back. No floor, no auction, no other private investor on the other side, waiting to sell the exact number of shares that were just bought. What is on the other side is a firm running an inventory book, and in the instant the order arrives, that firm is reading a short list of characteristics. Which security, which direction, how many shares, and above all, where the order came from. Not the name on the account, which it never needs, but the type of account it was sent from. That last item is the one worth paying for. By the time the confirmation appears, the question of who profits from the trade has already been settled, and it was not settled on an exchange. The mental model most people carry is a queue. Orders arrive at an exchange, buyers and sellers line up at their prices, and the two sides meet in the middle. That model is not wrong. It is a fair description of how an exchange works, and it is close to what happens when a pension fund buys 100,000 shares. It rests on one assumption, though, and the assumption is the weak point. It assumes the order gets to the exchange. In the United States, a retail order marked to execute immediately usually does not. It is routed instead to a wholesaler, a small group of firms with Citadel Securities and Virtu Financial handling the largest share, and filled from that firm's own inventory. The exchange price is used as a reference. The exchange itself is never involved in the trade. So the order looks like an instruction sent to a market. It functions like a package sold to a courier who paid in advance for the route. Every broker in the United States publishes a document each quarter under Securities and Exchange Commission Rule 606. It is a plain table. Venue names down one column, the share of orders sent to each one, and then the column that matters, the payment received, expressed per 100 shares for stocks and per contract for options. That table is the receipt for the entire arrangement. The mechanism it describes fits in one sentence. The broker does not charge the customer to trade. The broker is paid by the firm that takes the other side of the trade, per unit of order flow delivered. Think of a taxi dispatcher who takes no fee from the passenger, because one taxi company pays for every ride sent its way. The ride still happens. The passenger still arrives at the address. The only open question is whether the fare was the best one available, and the passenger has no way to compare it against the fare they did not get. Now, the part that would be a scandal in almost any other industry. The agent handling the order is paid by the counterparty to the order, not by the customer placing it, by the firm standing on the opposite side of it. This is disclosed quarterly in a public filing, and the filing is read by regulators, journalists, and essentially nobody else. The wholesaler is also not obliged to take everything. Orders that look like they carry information, unusual size, unusual timing, a name that has just started moving, can be handed off to an exchange rather than filled in-house. What stays in-house is the flow that is safest to trade against. The sorting happens in microseconds, and no account is ever told which side of it their order landed on. The payment rates explain the design of the apps themselves. Equity order flow pays a fraction of a cent per share. Options order flow pays in the region of tens of cents per contract, which is a different order of magnitude for a single click. Robinhood's 2021 accounts show transaction-based revenue of roughly $1.4 billion, and options were the largest single line inside it, ahead of both equities and crypto. Across the American industry, payment for order flow that year was estimated at around $3.8 billion. That leaves the obvious question sitting underneath all of it. Why would a firm pay real money every trading day for the right to trade against these particular orders? Because of what these particular orders do not know. All of this has an address, and it is not Wall Street. It is a stretch of northern New Jersey. The New York Stock Exchange runs its matching engines from a building in Mahwah. NASDAQs sit in Carteret. A third cluster, in Secaucus, houses much of the rest. From the road, they are unremarkable, long, low, windowless, set back behind fencing, No signage worth reading, generators lined up along one wall like shipping containers. Nothing about them suggests a market. They look like distribution warehouses, which in a literal sense is what they are. Inside, the floor is divided into cages of rented cabinets. Firms pay for space by the rack and for connections by the port, and the closer a machine sits to the matching engine, the sooner it learns what the market has just done. That advantage was so obvious that the exchanges neutralized it in the crudest way available. Every customer is given the same length of cable, regardless of where their cabinet physically stands. A firm 3 meters from the engine and a firm 30 meters away receive identical runs of fiber, with the excess coiled and stored so that nobody is nearer than anybody else. The fairness of the American stock market, at its most physical, is a room full of deliberately overlong cable, spooled and tied above the ceiling tiles. The wholesalers keep their machines in those same rooms. So an order routed away from an exchange has frequently not traveled anywhere at all. It has crossed to a different cabinet, sometimes a few meters from the exchange it appeared to be heading for, and been filled there. One interruption before the money moves. If this is the sort of detail worth knowing, subscribe. Now follow the money in the order it actually moves. Every quoted stock carries two prices at once. A bid, the highest price someone is currently willing to pay, and an ask, the lowest price someone is willing to accept. Buying pays the ask, selling receives the bid. The gap between them is not a fee that anyone charges or announces. It is the cost of crossing from one side to the other, and it is the raw material of this entire business. The official version of that gap is called the national best bid and offer, and it is the benchmark every execution gets measured against. When a buy order arrives at a wholesaler, the firm does not need to go and find a seller. It sells from its own book. It fills the order slightly better than the national best offer. 1/100th of a cent, 1/10th of a cent, occasionally more, and keeps what remains of the spread. That improvement is real. It is disclosed, and brokers advertise it heavily. It is also, stated plainly, a discount funded by the distance between the price the firm charged and the price it could have charged. Out of that captured spread, the firm pays the broker for the flow. The broker reports zero commission. The customer sees a fill price in the absence of a $9.99 charge that no longer exists anywhere in the industry. Then everyone else takes a slice. The clearing firm charges for settling the trade and holding the position. The Securities and Exchange Commission collects a small fee on every sale, and the Financial Industry Regulatory Authority collects another. The exchange, which never touched the trade, still sells the data feed that produced the reference price it was measured against. Count the parties paid in that chain, and one name is missing from it: the customers. That is the reveal underneath the mechanism. The broker's customer is the wholesaler. The wholesaler's product is a stream of orders that are statistically unlikely to be right about the next few seconds. It is the same toll logic behind Uber's take rate. The platform is not really selling rides, it is selling controlled access to a flow. Retail orders are worth paying for precisely because they arrive without information. A hedge fund's order might be the leading edge of something larger. 100 shares bought on a phone at lunchtime usually is not. Trading against orders that carry no information is a business with a small, known, repeatable edge. And the entire apparatus exists to keep that flow separated from the flow that bites back. You are not the customer in this arrangement. The order is the product, and the account is the inventory it is drawn from. In December 2020, the Securities and Exchange Commission charged Robinhood over exactly this. The order found the firm had misled customers about how it made money and had failed to seek the best reasonably available terms for their trades. The penalty was $65 million. Buried inside it is the more useful number. The commission calculated that even after subtracting the commissions customers had saved by not paying any, the inferior execution prices had still cost them $34.1 million. The firm settled without admitting or denying the findings, which is standard. The practice continued, which is also standard. It was never alleged to be illegal. It was alleged to be badly described. At the level of one trade, none of this is visible. 1/10th of a cent on 100 shares is 10 cents. Nobody's going to feel that, and nobody was ever meant to. The cost was not designed to be felt in a single trade. It is designed to be collected across every trade, in every account, every day, in a market where the charge that used to be visible has been removed and replaced with one that is not, which is the gap this channel is named for. The second gap here is the distance between the number that is advertised and the number that actually arrives. The advertised number is zero. Zero commission printed on the front of the app and completely true. The number that arrives is the fill price, the price the shares genuinely changed hands at, set inside a spread by a firm that paid for the right to set it. One of those is a headline. The other is the money. The size of that gap is not published as a single industry figure, and it would be dishonest to estimate one here. What is documented is a single instance, $34.1 million of harm at one broker over a defined period, calculated by the regulator after the commission savings had already been deducted. That is one firm. The rest do not disclose their equivalent. If a conclusion follows from the mechanism, it is a modest one, and this is an explainer rather than personalized financial advice. In securities with wide spreads, small companies, thin volume, quiet hours, a limit order sets the maximum price paid instead of accepting whatever price is offered. The cost of doing that is real. A limit order can go unfilled, and an unfilled order in a moving market is its own kind of expense. For anyone buying a large, heavily traded company in small size, where the spread is a single cent, the effort is not worth the trouble. The click was free. Everything that happened after it had already been sold.